I need you to pause everything right now and pay close attention to what I'm about to share with you. What I'll reveal in the next half hour will completely transform your understanding of silver markets, the banking infrastructure, and the existential threat developing beneath the surface of global finance. This isn't guesswork or theoretical analysis. This is pure mathematics, cold and irrefutable. The data I've analyzed signals we're nearing a catastrophic breakdown in precious metals markets that will spark the most severe banking crisis since 2008, potentially surpassing it. At this moment, as I'm recording on January 13, 2026, silver trades at $86.42 per ounce. To casual financial news viewers, this appears as just another rising commodity price, a simple percentage increase on a chart. However, those of us who grasp what's unfolding in derivative markets understand that $86 isn't merely a price point. It represents a trigger mechanism initiating a liquidation cascade capable of destroying institutions previously deemed too big to fail, institutions upon which the entire global financial architecture depends. I'm going to walk you through the precise positions maintained by JP Morgan, HSBC, and Scotia Bank. I'll demonstrate the mathematical inevitability of their bankruptcy if silver reaches $100. I'll reveal the emergency protocols the Federal Reserve is already executing behind closed doors to forestall systemic collapse. Most critically, I'll explain why your window to protect yourself is measured in weeks, not months. When this situation ruptures, when primary dealers begin declaring force majeure or requesting emergency bailouts, the financial terrain will transform overnight. Those who prepared will safeguard their wealth. Those who didn't will witness helplessly as the system seizes their deposits to preserve itself. Understanding the positions is absolutely essential because the magnitude of what we're confronting is staggering. The most recent Office of the Comptroller of the Currency quarterly derivatives report from December 2025 shows the top 4 U.S. banks controlling 93% of all precious metal derivatives in the American banking system. This isn't diversified risk distribution, this is concentration that should terrify any competent risk manager. The genuine exposure, the authentic danger, concentrates even further in just 3 institutions serving as primary dealers in the silver market: JP Morgan Chase, HSBC, and Scotia Bank. These 3 collectively maintain short positions representing $46 billion in notional value of silver derivatives as of December 2025's end. Let me clarify what this means practically, because here the danger crystallizes. A short position indicates they've sold contracts committing to deliver silver at specified prices. They profit when prices decline because they can purchase silver cheaper than their sale price and pocket the difference. They lose when prices rise because they must buy expensive silver to fulfill contracts they sold cheaply. Right now, with silver at $86 and climbing aggressively, they're hemorrhaging catastrophic sums daily. Every hour, every upward tick on the chart represents billions in additional losses. The mathematics I've reviewed reveals exactly how dire the situation is. When these short positions were established over recent years, the weighted average entry price approximated $54 per ounce. Some older positions entered at $40 or below, some newer ones at $70. Weighted by position size and timing, the average across all shorts sits at approximately $54 per ounce. With silver now at $86, they're underwater $32 per ounce on average positions. That's $32 per ounce on $46 billion notional exposure. Here's how you calculate actual losses and why this becomes an existential threat. The $46 billion notional value at $54 average short price represents approximately 851 million ounces of silver. Dividing 46 billion by 54 equals 851 million ounces. At $32 per ounce loss from current prices, that's $27.2 billion in mark-to-market losses. That's not something you hide in quarterly earnings. That's not a rounding error. That's not something accounting tricks can smooth over. That's an existential threat to these institutions' solvency. But it deteriorates significantly because silver isn't stopping at $86. The technical breakout I witnessed 3 days ago, the widening arbitrage spread with Shanghai, the physical shortage causing 8-week delivery delays at major mints, all point towards silver heading to $100 in the very near term, possibly within 2 to 3 weeks. At $100, the mathematics become absolutely catastrophic for these banks. At $100 per ounce loss increases to $46. Subtracting 54 from 100 equals $46 per ounce loss. Multiplying by 851 million ounces yields $39.1 billion in losses, just under $40 billion. Let me contextualize that number because here you must understand why this threatens the entire banking system. JP Morgan Chase possesses Tier 1 capital, the highest quality capital absorbing losses, of approximately $200 billion. HSBC has approximately $130 billion in Tier 1 capital. Scotia Bank has approximately $50 billion. Combined, these three banks possess roughly $380 billion in Tier 1 capital. A $40 billion loss represents 10.5% of their combined Tier 1 capital. That might not sound like complete annihilation, but here's what you must grasp. Banking regulations mandate Tier 1 capital ratios remain above certain thresholds. For globally systemically important banks, which all three are, the minimum Tier 1 capital ratio is 8%. But regulators grow extremely nervous and impose restrictions when that ratio drops below 10%. A $40 billion loss doesn't just damage these banks. It pushes them into danger zones where regulators must intervene, where restrictions get imposed, where emergency measures become necessary. But we're not stopping at $100. Let me show you what happens at $150, because that's where this becomes a civilization-level crisis. At $150 per ounce loss becomes $96. Subtracting 54 from 150 equals $96 per ounce loss. Multiplying by 851 million ounces yields $81.7 billion in losses. That's 21% of their combined Tier 1 capital. That level of loss doesn't just push them into danger zones. That level makes them technically insolvent. That level demands emergency intervention by central banks and governments to prevent complete systemic collapse. You might think they can simply close their positions, buy back contracts, and stop the bleeding. In normal markets, that's exactly what they'd do. But this isn't a normal market. This is a market where physical metal is vanishing, where premiums on physical silver run 9 to 12% over spot, where delivery times have stretched to 8 weeks. If these three banks attempted closing even 10% of their positions, tried buying back 85 million ounces of silver, the buying pressure would send prices absolutely vertical. It would trigger the very crisis they're attempting to avoid. They'd be buying into a rising market, pushing prices higher with every purchase, increasing losses on remaining positions. It's a trap, a mathematical trap with no easy exit. This is why primary dealers are fighting for survival right now. This isn't about protecting profits anymore. This is about preventing insolvency. This is about preventing a collapse, making Lehman Brothers look like a practice run. Here's the truly terrifying part. The Federal Reserve knows this. The U.S. Treasury knows this. The Bank for International Settlements knows this. They've all run stress tests. They've all seen the numbers. They're already taking emergency measures behind closed doors to prevent this from becoming public knowledge until they can execute a controlled solution. The evidence I've gathered shows this emergency response is already underway. On January 6, 2026, just 1 week ago, the Federal Reserve announced expansion of its standing repo facility. They increased the maximum amount primary dealers can borrow overnight from $80 billion to $150 billion. The official explanation was routine liquidity management. But that's not routine. That's a $70 billion increase in emergency lending capacity. That's the Fed preparing to inject massive liquidity into the banking system to prevent a derivatives crisis from becoming a banking crisis. On January 8th, the Federal Reserve Bank of New York held an emergency closed-door meeting with primary dealers. This wasn't on public schedules. This wasn't announced in advance. We only know about it because of regulatory filings submitted afterward. The official meeting description was discussion of market operations and liquidity conditions. That's Fed speak for figuring out how to prevent your collapse. 3 days later, on January 11th, JP Morgan transferred $42 billion from its broker-dealer subsidiary to its commercial bank subsidiary. That's internal capital transfer to shore up the entity facing losses from derivative positions. That's not normal operations. That's emergency capital reallocation. Then yesterday, January 12th, HSBC issued $2 billion in subordinated debt. Subordinated debt is expensive capital paying higher interest rates. Banks only issue it when they need to boost capital ratios quickly. HSBC issuing subordinated debt right now at premium interest rates reveals they're scrambling to build capital buffers against losses they know are coming. This is silent recapitalization. This is emergency preparation happening in real time while financial media discusses healthy market corrections and normal volatility. Now, let me explain what happens if silver reaches $150 before this recapitalization completes. This is the scenario keeping central bankers awake at night. If silver hits $150 in the next 60 days before primary dealers can build sufficient capital buffers, they face three options. None are good. All are destructive, and all end with ordinary depositors and investors paying the price. Option 1 is bail-in. A bail-in is when a failing bank recapitalizes itself by converting liabilities it owes creditors into equity. In plain English, that means they take your deposits and convert them into shares of the failing bank. Your cash disappears. Your savings account becomes stock in a collapsing company. This isn't theoretical. This isn't conspiracy theory. This is official policy implemented after 2008 to prevent taxpayer bailouts. The Dodd-Frank Act in the United States and similar European legislation specifically allows bail-ins of depositor funds above insured limits. In the United States, the FDIC only insures deposits up to $250,000 per account. If you have more than that in a single bank, the excess isn't protected. It can be bailed in. It can be converted to equity. Here's the part that should terrify anyone with significant deposits. During the Cyprus banking crisis in 2013, they didn't just bail in uninsured deposits, they took 47% of all deposits above 100,000 euros. People woke up one Monday morning and discovered half their savings had been converted into shares of failed banks. The shares were worthless. The money was gone. If JP Morgan, HSBC, or Scotia Bank faced insolvency from silver derivative losses, the same mechanism would be triggered. Deposits above $250,000 would be at risk. Given the loss magnitude we're discussing, $81 billion, the haircut could be massive. It could be 50%. It could be 70%. Wealthy individuals, small businesses, anyone with significant operational cash in these banks would see balances slashed overnight. The cruel irony is the people who would be bailed in aren't the people who caused the crisis. They're not the derivative traders. They're not the executives who built these massive short positions. They're ordinary depositors who thought their money was safe in a major bank. Option 2 is COMEX force majeure declaration. Force majeure is a legal clause allowing a party to void contracts due to extraordinary circumstances beyond their control. Wars, natural disasters, acts of God. In the context of COMEX silver futures, it would mean the exchange declaring that due to unprecedented market conditions, they cannot facilitate physical silver delivery. All contracts would be cash settled at a price determined by the exchange, not at market price, not at prevailing physical price, at whatever price the exchange decides is fair. Here's why this is devastating. If you're holding a silver futures contract intending to take delivery, expecting to receive physical metal worth $150 per ounce, and COMEX declares force majeure and cash settles you at $90 per ounce, you just lost $60 per ounce. You lost 40% of expected value and have no recourse. It's in contract terms you agreed to when you opened the position. COMEX has legal right to do this. If primary dealers cannot fulfill delivery obligations because they don't have physical metal and cannot acquire it without bankrupting themselves, force majeure becomes not just an option, but a necessity. The consequences of a COMEX force majeure declaration would be profound and lasting. It would destroy confidence in the paper silver market permanently. It would prove futures contracts aren't backed by real metal. It would validate every conspiracy theory about price suppression and market manipulation. It would cause immediate and total decoupling of paper prices from physical prices. Physical silver would trade at massive premiums to worthless paper contracts. Anyone holding ETFs that settle in cash, anyone holding futures, anyone with paper exposure would be wiped out. Only holders of physical metal would preserve their wealth. Option 3 is direct Federal Reserve intervention through unlimited quantitative easing. This is the most likely outcome because it's the path of least political resistance. The Fed cannot allow major banks to fail. The Fed cannot allow COMEX to declare force majeure. So they'll do what they always do. They'll print money. They'll create dollars from thin air and use them to recapitalize failing banks. They'll buy bad derivative positions onto the Fed's balance sheet. They'll socialize losses and stick taxpayers with the bill. But here's the problem. The Fed's balance sheet is already at $8.9 trillion. It peaked at $9 trillion during the pandemic and has only declined slightly. If they need to inject another $80 to $100 billion to save primary dealers from silver derivative losses, that pushes the balance sheet back toward $9 trillion. And that money doesn't disappear. It enters the economy. It increases money supply. It causes inflation. Not just minor inflation. We're talking about gasoline hitting $7 per gallon, groceries up another 20%, rent increasing 30%. The currency debasement required to save these banks from their silver bets would destroy the purchasing power of every dollar-denominated savings account in America. Let me lay out the timeline of how this unfolds, because understanding the sequence helps you position correctly. We're currently in Phase 1, silent recapitalization. Banks are quietly raising capital, transferring funds, expanding credit lines, and building buffers. The Fed is expanding lending facilities. Regulators are having closed-door meetings. This phase lasts as long as silver stays below $100, and they have time to build defenses. We have maybe 3 to 4 weeks left in this phase. Phase 2 begins when silver crosses $100. At that point, losses become too large to hide in quarterly reports. Analysts will start asking questions. Shareholders will demand explanations. Media will start covering the story. Volatility will increase dramatically as banks try defending the $100 level through massive paper selling, through algorithmic suppression, through every tool they have. But if physical demand remains strong, if Shanghai keeps buying, if industrial users keep panicking, the defense will fail. Phase 2 is the battle for $100. It could last days or weeks depending on buying pressure intensity. Phase 3 is capitulation and crisis. This happens when silver breaks above $120 and heads toward $150. At this point, banks realize they cannot win. Losses are too large. Physical shortage is too severe. They stop defending and start preparing for emergency measures. This is when you see credit rating downgrades, when you see debt issuance at distressed levels, when you see executive departures, when you see emergency board meetings. Phase 3 is chaos. It's when financial media finally admits there's a crisis. It's when politicians start making angry speeches. It's when you see congressional hearings scheduled. Phase 3 ends with intervention. Phase 4 is resolution through one of the 3 options I've described: bail-in, force majeure, or Fed bailout, or some combination of all 3. By the time we reach Phase 4, decisions have already been made in smoke-filled rooms. Public announcements are just theater. Your money has already been taken or devalued. Your positions have already been closed or converted. Phase 4 is when you discover whether you positioned yourself correctly during Phases 1 and 2. So what should you do? How can you protect yourself from this? This is not a time for passive hope. This is a time for active defense. First, if you have deposits above $250,000 in JP Morgan, HSBC, or Scotia Bank, move them immediately. Not next month, this week. Spread them across multiple banks. Keep no single institution exposure above FDIC-insured limits. Yes, it's inconvenient. Yes, it's a hassle to manage multiple accounts. But convenience isn't worth the risk of losing half your money in a bail-in. Warning signs are already visible. Emergency measures are already underway. By the time this becomes public knowledge, it will be too late to move your money. Banks can freeze large withdrawals during crises. They can impose capital controls. They can limit daily withdrawal amounts. Move your money while you still can. Second, if you have any exposure to silver through paper products, through ETFs like SLV, through futures contracts, through unallocated bank accounts, you need to understand your counterparty risk. Read the fine print. Most of these products have force majeure clauses. They have cash settlement options. They have provisions allowing the institution to give you dollars instead of metal if there's market disruption. A COMEX force majeure declaration is exactly that kind of market disruption. If you want exposure to silver, hold physical metal or hold PSLV, which has transparent allocated storage and redemption mechanisms. Don't trust promises. Don't trust contracts that can be voided. Trust only what you can hold or what is verifiably allocated in your name. Third, diversify out of the banking system entirely for a portion of your wealth. This isn't about abandoning banks completely. This is about reducing concentration risk. If you have significant wealth, consider holding a portion outside the traditional banking system. Physical precious metals in private vaults or home safes, real estate you own free and clear, productive land, businesses generating cash flow, assets that cannot be bailed in, assets that cannot be frozen by capital controls, assets that maintain value regardless of what happens to bank balance sheets. Diversification's purpose isn't to maximize returns. The purpose is to survive extreme events, and we're heading into an extreme event. Fourth, prepare for currency debasement regardless of which option they choose. Whether it's bail-in, force majeure, or Fed bailout, all three outcomes lead to the same place: loss of purchasing power, destruction of dollar-denominated savings. If they bail in deposits, confidence in the banking system collapses and people flee to hard assets. If they declare force majeure, confidence in dollar-denominated contracts collapses, and people flee to hard assets. If the Fed prints $80 billion to bail them out, money supply increases and each dollar's value decreases. All roads lead to inflation. All roads lead to debasement. Position yourself in assets that benefit from currency destruction. Real assets, productive assets, assets with intrinsic value. Fifth, understand this isn't just about silver. This is about the fragility of a highly leveraged financial system built on derivatives and fractional reserves. Silver is just the trigger. Silver is just the match lighting the fuse. But once the fuse is lit, once confidence begins cracking, the crisis spreads. It spreads to other commodity derivatives. It spreads to interest rate swaps. It spreads to credit default swaps. The entire $200 trillion derivatives market is interconnected. Failure in one corner can cascade through the system. This is why the Fed is so terrified. This is why they're taking emergency measures now. They know a silver derivative crisis could become a systemic crisis very quickly. Historical context matters because this has happened before and will happen again. In 1998, Long-Term Capital Management, a hedge fund run by Nobel Prize-winning economists, collapsed because of derivative positions in Russian debt and interest rate spreads. They had $14 billion in capital and $1 trillion in derivative exposure, 71-to-1 leverage. When their positions moved against them, they faced bankruptcy. Because they were counterparties to every major Wall Street bank, their bankruptcy would have triggered cascade failures throughout the financial system. The Federal Reserve had to organize a private sector bailout. 14 banks contributed $3.6 billion to keep LTCM alive long enough to unwind their positions. The crisis was contained, but it was a very close call. In 2008, Lehman Brothers collapsed because of derivative exposure to mortgage-backed securities. They had $25 billion in capital and $600 billion in debt and derivatives. When the housing market collapsed, their positions became toxic. No one would trade with them. Counterparties demanded more collateral. They couldn't meet margin calls. They filed for bankruptcy. That bankruptcy froze global credit markets. Banks stopped lending to each other because no one knew who else was exposed to Lehman's toxic positions. The commercial paper market froze. Money market funds broke the buck. The entire financial system came within hours of complete collapse. The Fed had to inject trillions in emergency liquidity. The government had to bail out AIG, Citibank, Bank of America, and dozens of other institutions. Even with all that intervention, the economy still collapsed into the worst recession since the Great Depression. Now imagine that scenario, but with three major banks simultaneously facing insolvency from silver derivative losses. Imagine the panic. Imagine the contagion. Imagine the emergency measures required to contain it. That's what we're potentially facing in the next 60 to 90 days if silver continues its march toward $150. Based on the technical setup I've analyzed, based on physical shortage, based on arbitrage spread with Shanghai, there's no reason to believe silver will stop at $100. The momentum is too strong. The fundamentals are too tight. The fear of missing out is too powerful. I want to address people who think banks will just manipulate the price back down, who think they'll engineer another smash like they've done so many times before, who think this is just another bull trap ending with silver back at $70. That strategy worked when banks had unlimited physical metal to deliver against short positions. That strategy worked when China was a price taker and would accept whatever price the West set. That strategy worked when there were no export controls and arbitrage kept global prices aligned. None of those conditions exist anymore. COMEX-registered vaults are at historic lows. China has implemented export licensing, trapping metal inside their borders. Shanghai is setting the price, and New York is following. The old playbook doesn't work anymore. The game has changed. Every attempt to smash the price now just creates buying opportunities for physical buyers. Every artificial dip gets absorbed immediately by industrial users desperate for metal. Every paper dump gets overwhelmed by physical demand. The banks are fighting the tide. They're trying to hold back the ocean with a broom. It won't work. Every day they try, every day they defend these price levels, they dig themselves deeper into insolvency. Losses compound. Positions grow larger. The hole gets deeper. This is why the window to act is measured in weeks. By the time this becomes obvious to everyone, by the time it's on the front page of the Wall Street Journal, by the time your financial advisor is calling with concerns, it will be too late. The bail-ins will have happened. The force majeure will have been declared. The Fed will have announced emergency measures. Your deposits will be frozen or converted. Your paper silver positions will be cash settled at unfavorable prices. Your wealth will have been confiscated or devalued to save the system. The time to act is now, while you still have options, while you still have control, while the crisis is still hidden beneath the surface. I'm not telling you this to scare you. I'm telling you this because you deserve to know the truth. You deserve to understand the risks. You deserve to have the information necessary to make informed decisions about protecting your wealth. The mainstream financial media won't tell you this. They're dependent on advertising revenue from these same banks. They have relationships with these institutions. They don't want to cause panic. They don't want to be responsible for triggering a bank run. So they downplay the risks. They call it normal volatility. They say the system is sound. They tell you not to worry. But behind the scenes, emergency measures are already underway. Recapitalization is already happening. The crisis is already here. It's just not evenly distributed yet. The mathematics are clear. At $100, these banks face $40 billion in losses. At $150, $81 billion in losses. Those numbers aren't sustainable. Those numbers force intervention. Intervention means someone pays. Either depositors pay through bail-ins, or paper silver holders pay through force majeure, or taxpayers pay through Fed bailouts. One way or another, wealth will be transferred from the public to save these institutions from their derivative bets. The only question is whether you'll be on the paying side or whether you'll be positioned in assets protected from the carnage. The crisis is coming. The timeline is compressed. The window is closing. Move your deposits. Convert paper exposure to physical. Diversify out of the banking system. Prepare for currency debasement. Do it now. Do it this week because next month might be too late. Primary dealers are approaching insolvency. The Fed is preparing emergency measures. And the price of silver is going higher whether they like it or not. Position yourself accordingly. The mathematics don't lie. And the mathematics say this ends very badly for anyone who isn't prepared.